Watch out! The money in your bank is at risk. New intel shows us why. Now, with the Federal Reserve's commitment to crushing demand in the economy, of course to lower inflation, it's putting massive strain on all financial markets, assets, and institutions. We've seen insurance companies, investment banks, pensions, and even your bank has been caught trying to earn some yield, some return in a zero interest rate world, forcing them to get more creative and more risky with their investments. And it's been fine until it's not. Now, the Federal Reserve's resolve and commitment to fighting inflation has seen them raise rates higher and faster than any other time in history. And now, all these creative and risky financial bets are turning into dangerous problems and could collapse the entire system like a house of cards, or more like a stack of dominoes. And you get it. Your asset prices are coming down, and many of you are staying in cash until you're ready to get back into the markets. But what about your cash in the bank? Now, it's protected by the FDIC or whatever regulatory insurance body you have in your country, right? Well, maybe not. In fact, a video of a closed-door meeting of the FDIC just surfaced, and you won't believe what they said. And you need to know. So, in this video, I'm going to break down the highlights of what they said, what they mean, the dangers of the cash in your bank account, whether you're in the United States, Europe, Australia, or Canada, what the rules and restrictions are for them, either taking your money or paying you back, and of course, how you should protect yourself in case the worst happens. So let's go. All right, welcome back. If you're new to the channel, my name is Mark, and I'm here to change the way you think about money. Almost everything you've heard, you've learned, and you see is wrong. It's hard to see the right data, and of course, the Federal Reserve right now is trying to crush your retirement account, crush your savings, crush your home, all your assets. So maybe a lot of you are hiding in cash. I've been parking a lot of cash. I've been deploying a lot through 2022. But what if that cash is at risk? Now, a lot of you think it is at risk. I've been kind of trying to calm some of those fears. But new information shows that it might be at risk. So what am I talking about? Is your cash, is your money at risk? Now, there was an FDIC, Federal Deposit Insurance, right? They're supposed to insure your deposit, your money in the bank. The FDIC had a meeting in November of last year, and we've got some video of that meeting, and we can listen to exactly what they say. Now, I'm a big fan of going back to the source. If you want to know about the World Economic Forum and the Great Reset, then go read Klaus Schwab's book called The Great Reset, right? I want to go to the source. I want to get the information directly from the person, and let's get the information directly from the FDIC. Now, they said a lot of things that, like, we should warn the public, but we don't want to cause a bank run. They said that we could fire off a bunch of unintended consequences. Rather than me tell you what they said, let's hear it directly from them. I got a couple clips to play. So let's go ahead and play this first clip here where they talk about your money could be taken in a bail-in. Let's play that clip.
And it's really important. I mean, it's a little bit conflicted, right? I mean, it's important that people understand they can be bailed in, but you don't want a huge run on the institution. But they have, I mean, they're going to be.
Okay, so they're going to be. That's what he said. They're going to be. The people should know that they could be bailed in. So what does that mean? Well, you remember in 2008, the great financial crash, the banks crashed the market. They tried to blame it on greedy homeowners. It was the banks. They crashed the market, and the banks had to be bailed out. Taxpayer money was given, our money, you and I, our taxpayer money was given to the banks to bail them out. A bail-in is the opposite. No bailout, no help coming from the outside. Instead, they take the assets of the people in the bank, the unsecured creditors, you and I. Now, something you may not know is that the money in your bank is not your money. When you fill out all those documents, that whole packet of documents with the bank, legally, you've given the money to the bank. It's not yours anymore. You are now an unsecured creditor. Now, if you know anything about debt and credit and bankruptcy, you know that an unsecured creditor is not a good place to be. No one ever gives you a loan unsecured. You have to secure it personally. But you're an unsecured creditor of the bank. So what he's saying is that the public should know. They should know that they could be bailed in. However, we don't want to scare them because then they might go pull their money out of the bank. We don't want that to happen, but he said they will be. So anyway, that's pretty scary. Let's hear this next clip right here where they're kind of saying the quiet part out loud. Let's go ahead and play this clip.
When people need to know, but I don't think you have much hope of reaching a public that doesn't have a professional need to know.
Okay, so this is another person at the FDIC meeting saying that, well, the people should know, they deserve to know, but, you know, outside of professionals, they probably don't need to know. So, you know, your money in the bank, probably going to be taken in a bail-in, that's what they said, but you don't need to know. Now, I beg to differ, which is, of course, why I'm making these videos. I want to make sure you know. Now, if that's not good enough, let's keep going and see what else they have to say. So he finished saying that people deserve to know, but they probably don't need to know. And let's hear what they have to say after that.
I completely agree with that. I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim, right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do.
Okay, so he completely agrees. The people should know, but we don't want to tell them because it could cause unintended consequences like everyone going and getting their money out. They don't need to know what risk they have. That's what he said. The best part was the end. Again, this is the FDIC meeting, the ones that are insuring your money, and he says, what's funny, or he said, I guess the reality is that the public seems to trust the banking sector more than we do. The people insuring your money. So that's what they think about that. I got one more clip here that I want to play for you. Let's go ahead and roll that clip.
So there's a select crowd of people that are in the institutional side. And if they want to understand this, they're going to find a way to understand this. There's a bunch of law firms represented in this room. There's a bunch of people that will charge them by the hour a lot of money to explain this all to them. And it's fine. I don't have a problem with that. And they all have huge staffs. But I would be careful about the unintended consequences of starting to blast too much of this out in the general public.
Okay, so again, we need to control this information. We don't want to get into the public. Now, some people are going to find out about it. The professional institutional managers that have an army of attorneys, they're going to find this out. But we need to be very careful about the public getting this information. So they're even talking about running campaigns to control what they call misinformation, like this video. But, you know, the professional money manager with an army of attorneys can find this out, but we don't want you, the public, to know this. But don't worry, I got your back. That's what I'm here for. I'm going to break this down for you. So you probably have more faith in the banking system than the FDIC that's insuring your money has. Now, what I say often, I say they're saying the quiet part out loud. And it really scares me when they start to tell you this stuff up front. It's one thing when they hide it and they lie about it, but we see it anyway, but at least they're hiding it, lying about it, which means they're kind of ashamed about it, right? But when they come out and just admit it to you, that's when it's time to actually get scared. So you are going to be bailed in. That's what he said. They are going to be bailed in, all right? But who will tell them? No one should tell them. We need to keep it away from them, keep this information away. The public doesn't need to know. You don't need to know the risk that your money's at. And who's going to explain it to them? That's me. I got your back. Don't worry. All right. Now, this was taken, if you want, you can just Google this right here, FDIC Systematic Resolution Advisory Committee. You can just Google it. You'll find it on the FDIC website. You can watch the whole video if you want. It's really boring. You probably don't want to. You need a team to give you this information. All right. Now, let's talk about FDIC insurance for a little bit, and let's look at the risk that you really have and how you protect yourself. All right. So, FDIC was created to insure deposits in 1933. Now, why 1933? Well, you might remember, I talk about all the time, Executive Order 6102. That's when the United States government bailed in the banks. They stole your money. So for all of history, 5,000 years, gold was money. We put the gold in the bank. The bank gave us back a paper gold certificate, an IOU, $1. And anytime we want, we can go redeem that dollar for gold. But in 1933, Executive Order 6102, they seized all the gold and they made it illegal for you to own gold. And all you were left with was a piece of paper that was worth nothing and it wasn't redeemable for gold. So they seized everybody's money, their gold, took it, made it illegal for you to own it. Then they instantly devalued it. And then they turned around and put insurance on top of it. So it starts from a very shady place of the government already doing this, stealing your money. Now, FDIC insurance, they've changed it over the period, since 1933. Currently, it insures accounts up to $250,000. So a lot of people think they're safe with that. well, maybe you're not so safe with that. So a couple things that you need to keep in mind. First of all, directly from the FDIC website, we find the coverage limits. So it's $250,000 per depositor. So a lot of times people think, well, I'll put, $200,000 in this account, I'll put $200,000 in that account. But it's not per account, it's per depositor. Okay, that's a big difference. Per depositor. So FDIC provides separate coverage for deposits held in different account ownership. Different account ownership. So not separate accounts per depositor. So if you have two $200,000 accounts, you're not insured. Per ownership categories. It may qualify for coverage over $250,000 if they have funds in different ownership categories. This is the key piece. Depositor. Different depositors, different ownership. All deposits that our account holder has in the same ownership category at the same bank are all added together and insured up to the standard insurance amount. So again, you have two accounts, $200,000 each. They put that together, and right off the bat, you're over, okay? Now, what about the even ability to pay this back? So the FDIC insurance company is supposed to have money to pay back, but do they have the money? So we see that they insure over $9 trillion in bank deposits, but they only have $125 billion in assets. So if the banks were to collapse and they were to lose trillions of dollars, how do they pay that back? They only have $125 billion in assets. That's a big problem. So who gets the money? Well, I know what a lot of you are already thinking. You're thinking, well, Mark, the government would bail them out, right? The Fed will just create money, print it, and just give it to them, right? Of course. Well, maybe not. Let's take a look at that. So if you remember, I already referenced in 2008, the great financial crash, the banking collapse, the taxpayers had to bail out the banks. And after that, they passed all types of banking reform, one of which was called, Dodd-Frank. And Dodd-Frank Wall Street Reform and Consumer Act was passed January 21st of 2010. And it was a sweeping overhaul of the financial markets. And it was to strengthen the financial markets in case of another 2008 financial crisis, like where the banks become insolvent and can't pay their depositors. And again, if people want to pull their money out of the banks collapse, which is why they don't want to tell you this. Now, the law also provides for an expedient liquidation process for any insolvent financial institution. So any institution that becomes insolvent, there's a process. What is that process? Well, we find out the process referred to as, quote, statutory bailins. Statutory bailins includes expanded powers to the Federal Reserve, the Securities and Exchange Commission, the SEC, so the Fed, the SEC, and also FDIC. And it says here, companies can be placed in receivership under federal control with the FDIC. So what does that mean? Do you know what receivership is? Look it up. If you've been through bankruptcy or know someone who has been through bankruptcy, or if you have money at, Celsius or BlockFi or FTX, any of these companies going through bankruptcy right now, you're probably finding out the hard way. You gave your money to BlockFi or Celsius or FTX. You were an unsecured creditor. Now they're filing for bankruptcy. There's a receiver that's going through all the assets to figure out what's left to give to who and who gets money first. Well, secured creditors get the money first. Unsecured creditors get the money last, and the receiver is who decides that. So the Fed, the SEC, and the FDIC will put the company into receivership under federal control. So the receiver is then going to go, okay, well, the asset's in receivership. I have to decide how we divvy up this money, and well, there's not enough for everybody, so who gets it first? And you're an unsecured creditor. So that's how this works. Now, we keep going on. If you understand Dodd-Frank a little bit, remember what it was for. It was for no more bailouts. All right. So the most affirming stance this new law makes is that, quote, too big to fail. Remember that term. Too big to fail financial institutions will not be bailed out by taxpayer dollars. That was the whole point. Taxpayers were pissed. We can't just bail out these banks. Private profits, but we socialize the losses. Forget that, right? And so we're not going to bail them out anymore. So protecting taxpayer money, you and I, from becoming the principal priority of the new U.S. reform. So the whole point of the reform is no more bailouts for the banks. But what about the depositors? Well, The depositors are backed by FDIC, but FDIC doesn't have enough money. But no worries, right, Mark? Because the government's going to bail them out. Well, the whole point of Dodd-Frank was that there were no more bailouts. So is there going to be a bailout coming for you? Well, we'll have to see how that goes. I understand, and let me know. Light up the comments already right now, right? People would riot. There would be protests. The government would be forced to do something, right? I mean, they're going to go against Dodd-Frank and they're going to bail them out? Maybe. Maybe. They go into receivership. How long does bankruptcy take? How long is your Celsius or your BlockFi or your FTX case going? Right? It goes on for years. You may not have access to that money for a long time while they're working this out. If they decide they want to change a law, how long does it take to change a law? Do you want to deal with all of that? Let's keep going. Now, this is also in Europe, so it doesn't matter where you're at in the world. Australia, Canada, Europe all have basically the same type of regulations. In 2013, the EU introduced resolutions to make the bail-in a common principle. All right, we saw this, it happened in Cyprus. They were very happy with the way it worked in Cyprus. I believe accounts over $100,000 got 47%, about half their money was taken, was gone. The same way Dodd-Frank did in the United States. So just like we have Dodd-Frank in the United States, EU has something very similar to that. All right, so now this sounds pretty scary, right? How do you protect yourself from this? Well, let's go back. So what we do is we try to go back and look at that past situation back to 1933 when they seized the money the first time. How would you have protected yourself from that? They took the gold, they took it from you, and then they gave you worthless paper, and then they devalued it. Well, if I didn't have any gold in the bank, if I had like a bunch of land and 100,000 head of cattle, you know, something like that, I wasn't affected. I still had my land, I still had my cattle, right? I wasn't affected because my gold wasn't in the bank. So first of all, if you don't have money in the bank, if you're broke, you probably don't have to worry about it, all right? But otherwise, if you do have money, what should you do? Well, a couple things. One, diversify across financial institutions. Some financial institutions are more risky than others. In 2008, some went out of business, some didn't. So diversify across financial institutions. You also want to check the bank's stability. Some banks are more risky. How do I know which banks are more risky? Well, banks with large derivatives and large mortgage books. Those are going to be the ones that are the most exposed. Now, which ones will be less exposed? Well, I like brokerage accounts, so money at Charles Schwab or E-Trade. They don't have mortgage books. They don't do derivatives, right? So they're way less risky, and they still have FDIC insurance if that works. Credit unions, you know, local banks, etc. So they're not doing large derivatives. They're not doing mortgage books, so you can stay away from those types of banks. And you can divide it up. Now remember, it's per depositor, so you might also need to have different ownership accounts. So think about different corporations, business entities, trusts, things like that. Another thing is that, you know, like I said, I'm holding cash right now. I've been stockpiling quite a bit of cash. Now, what do I do with that cash? Well, we can also put it into like money market accounts. You can make 4%, 4.5% in money market accounts, which goes into like the Fed accounts. So it's protected, it's at the Fed as opposed to being in a bank. You can do CDs where it's locked up in that. You could even start to buy treasuries, which is basically the risk-free asset they call it, right? Government treasuries. So these are different ways that you can do that. And of course, like I said, assets out of the bank. Gold, silver, real estate, heads of cattle. I got some, 6 cows now. I got 10 goats, and Bitcoin, of course, right? All of that is outside of the reach of the government. And so, depends on how much cash you have. It's going to depend on how much you need to worry about this. Again, if you're broke, you don't really need to worry about it. But what do you need to worry about if you are broke? Well, you need to understand what happens here. It could lead to civil unrest. And if the government does cave and print that money, then we're going to see 10 trillion, $20 trillion printed like that. And then what happens to prices? Then what happens to asset prices? Think about that. You got to plan ahead. All right. Hopefully that makes sense. If you'd like more on this, let me know in a comment down below. Of course, as always, give me a thumbs up on this video if you like it. If you don't, you can give me a thumbs down. That's okay. But at least tell me why in the comment. Also, I'm having a special live event. I got Robert Kiyosaki headlining and a bunch of other really cool people that you want to hear talk about this new parallel economy that's just starting. It's a massive opportunity. We're going to do 3 days of content. There's a link down below if you want to check it out. And that's what I got. All right. To your success. I'm out.